The key thing happening today is the questioning of the US exceptionalism trade, which has been persistent for the last 14 years.
We've seen the US exceptionalism start to turn around. The biggest driver right now is around trade and the reimagining or reforming of trade policies. And so the markets are really coming to terms with that, both the uncertainty as well as the process.
And there is a reset in expectations with respect to growth, with respect to inflation and the dollar. US has outperformed at a compounded annual growth rate of 13% returns over the last 14 years versus 5.5% for the rest of the world. And I think the overwhelming tariffs have questioned that exceptionalism to sustain. We started the year with 12 to 13% earnings growth expectations, and I think that was high.
Starting point was over-indexed to the US, overweight to the US. And so the selling you could classify as rebalancing or removing the overweight. Putting those two things together, it makes a lot of sense that you start to see trimming of US positions, both fixed income and equities. And then as you reallocate, Europe is a great example where growth expectations are starting to rise.
There are two important things to keep in mind. One is the confidence measures and how that impacts in business and CEO communication with respect to their CapEx plans and their earnings estimates. But also one must keep in mind that the dollar has weakened. And the dollar can help some of the exporting companies' revenues because 35% of the US market earnings comes from outside. So it's not very clear at this stage, but the earnings estimates that we started in the beginning of the year will eventually come down through the course of the next couple quarters.
The backdrop here of the US economy is a good one. We can't lose sight of that. The US has deep and rich capital markets. It has a wonderful, innovative economy. Those things are likely to continue. So we got to remember where we're starting from here, and are these big, long structural changes, or are they shorter-term dynamics that we need to navigate through, but the underpinnings are still very healthy. And so I don't think we're in a place now where it's a exit of the US, it's a rebalancing, and there are opportunities elsewhere that people are looking to capitalize on.
So the net international position of the US is negative 85%. What does that mean? Foreigners own more of US assets than US owners of foreign capital. That position is a large amount of that is in US Treasuries. And there is a questioning about the riskiness of that segment, and therefore international investors like the Japanese have been selling. It's important to keep in mind that the central bank credibility, the judicial institutions' credibility, the institutional checks and balances that this economy has offered historically is getting undermined and questioned with the recent policies and the recent comments by this presidency. And that is creating a little bit of the fear in US Treasuries.
There's a time bound here that's really interesting and important to think about, because having periods of time where these are going on, where there's geopolitical issues, renegotiations, tensions, what have you, okay, but prolonged periods of that level of disruption become problematic.
If there is a real crisis of confidence because of any policy announcement, that can cause capital flight. If there is a policy mistake by the central bank, not in the base case, but can that lead to some kind of a confidence issue? And a geopolitical event, a black swan event, is the other risk that can hit the market.